Welcome back, everyone. Today, we're diving into a lesson on candle range theory, or CRT, as promised. This isn't for those seeking a quick fix strategy or looking for spoon-fed shortcuts. This video is an in-depth guide for those who are truly dedicated and eager to learn more. Everything you need to understand CRT will be covered here. Now, let's get into the core of the CRT concept. Candle range theory played a crucial role in helping me develop my 9 a.m. CR model. I've seen comments suggesting that I'm merely repeating others' teachings, but that's not the case. The 9 a.m. CR model, while rooted in the principles of CRT and the power of three, open, high, low, close, is a unique approach specifically designed with timing in mind. So what exactly is CRT? Let's break it down. CRT, or candle range theory, involves analyzing the formation of candles over specific time intervals. Here's a quick overview. The first candle establishes the range, marking the high and low points. The second candle often manipulates above the initial range, creating a wick or a false breakout, commonly known as turtle soup. Finally, the third candle typically moves lower, aiming for the range's low. So, what is CRT? CRT stands for candle range theory. Candle range theory, CRT, typically manifests as a three-candle pattern, but it's important to note that it doesn't always adhere strictly to this structure. While the three-candle model is common, it's not a hard rule. For instance, in this example, you can see that multiple candles are utilized to reach the range high. We start with a range, an inside bar, and a turtle soup setup, moving from the low to the high of the range. There are two primary CRT models that can develop: the traditional three-candle model, which many are familiar with, and a more advanced version known as CRT plus inside bar. The CRT plus inside bar is often a higher probability setup, making it ideal for those seeking more reliable trades. So, what exactly is a CRT plus inside bar? As explained, this setup involves more than three candles to complete the movement from one end of the range to the other. Multiple candles form within the CRT range. To clarify, the range is defined by the first candle. The key difference between a CRT plus inside bar and a standard three-candle CRT is that the former takes longer to form. However, it offers a higher probability of success, making it particularly beneficial for traders who prefer to wait for confirmation or for those who are newer to trading. Now I'm going to show you several examples of candle range theory, CRT. I've noticed many people asking for more examples, so let's dive into it. Here, you can see a range forming with a turtle soup pattern, which then moves towards the opposite end of the range. The same thing happens here. Another turtle soup pattern drives the price to the other side of the range. In this example, we have a CRT setup combined with an inside bar. The turtle soup pattern again pushes the price towards the opposite end of the range. Now, here's a great three-candle model. A range forms, followed by accumulation, manipulation, and distribution, the classic power of three. You can see the same pattern in this instance as well, with a range forming and an inside bar, leading to a turtle soup pattern that moves the price to the opposite side of the range. It's all pretty straightforward and simple, but mastering this concept can significantly change your trading approach from here on out. As ICT teaches us, an algorithm is controlling the market. These highs and lows are predetermined. You can combine CRT with all concepts. However, using the power of three and turtle soup will give you highest probable trades. Here is an example of CRT on lower time frame. Here we have the range high and range low turtle souped, the range high breaking down, forming an order block. We close below the order block, that is change in state of delivery. The CSD, this is our entry point coming down, partial taking at equilibrium, always why? Because EQ is the midpoint where reversals or continuation take place. If you only focusing to targeting the EQ of the range, your win rate will be a lot higher. As you can see, we hit the EQ and retrace back to FVG and heading all the way down to the opposing end of the range. That was in 5.28 RR trade. This is what CRT allowed to you. Here we have the high and low of a CRT candlestick. We've captured the range's high. Pause the video and think about what might happen next. For those who didn't pause, it's important to take a moment to focus and think about it. This helps you learn better. Clearly, this was a turtle soup setup. In a 3-candle CRT, we form the ranges high and low, turtle soup the high, and then hit the range low with the third candle. If we don't close above a candlestick, this is bearish. Remember, each candle is a range no matter the time frame: monthly, weekly, daily, 4-hour, 1 hour, 15-minute, or 1 minute. Every single candle is a range. Time is fractal, meaning a daily chart is a higher time frame for a 4-hour. A 4-hour is a higher time frame for the 1 hour, and so on down to the 1 minute and even the seconds chart. Because time is fractal, every timed range is fractal too. Every candle is a range. Ranges can either be turtle souped or broken and retested. Every candle has a high, low, open, and close. On lower time frames, these make up a specific range. This is important because some candles are more predictable than others, especially during certain times of the day. These times help you figure out the higher time frame bias. Check if a higher time frame candle has been turtle souped. That's key to understanding bias. Don't force it. It'll be obvious when it's time to enter. For example, here we wicket above the candle's high. This is bearish because we didn't close above it. The same logic applies here when we wick below the low. This is bullish. The key thing to understand is that closing above a candle's high is bullish, and wicking above it is bearish. The opposite is true for lows. Wicking below is bullish, and closing below is bearish. The power of 3, also known as AMD, accumulation, manipulation, distribution, represents 3 stages of price movement. Each stage has a specific role, as I mentioned earlier. Use the power of 3 by combining it with your knowledge of candles as ranges. What does this mean? In a 3-candle CRT, one candle is accumulation, another is manipulation, and the third is distribution. The highest probability trades occur when you understand this pattern, which happens in every candle because time is fractal. Every candle has a range. This is a prime example of the power of 3. We accumulate. What are we accumulating? Sell side and buy side liquidity. Sweep sells side liquidity, hitting a key level, manipulating turtle soup, and distributing higher. This is critical to grasp. Here's an example. We form a range high and low, wick above the high. What happens next? Pause and think about it. The first candle draws the range, accumulation. The second candle wicks above the high, bearish because we didn't close above, which is turtle soup, manipulation. The third candle should be distribution, moving towards the other end of the range. Let's look at this example on a lower time frame. The first candle is the gray area, the second is the red area. Now where's the entry? Focus. First we're bearish. We've souped the range high, so where's the entry? Short. Here's the order block that forms. How did it form? How is it confirmed? When we close below this candle, we've confirmed the order block. Price then retraces into the order block, which is your entry to short towards the midpoint of the range, and then the opposite end. The third candle is distribution. If you trade the third candle only, it opens, rises above the entry point, and moves within the order block before you short. As I mentioned, there are 2 types of CRT, the 3-candle CRT and the inside bar plus CRT. The 3-candle CRT is a simple concept where 3 candles represent different stages: accumulation, manipulation, and distribution. The first candle sets the range, and after it closes, you mark the high and low points. This range is set at a specific time of day, not randomly. The second candle usually moves above or below this range, which is called a turtle soup. This movement offers most advanced entries for experienced traders. The third candle is where you'll see the fastest and most likely trades, which is the distribution phase. Beginners should focus here because it's quick and easy to understand. If you're expecting prices to drop, bearish, look for entry points above where the third candle opens. If you think prices will rise, bullish, look to buy below the third candle's open. Here's an example on a lower time frame. The first candle sets the range, the second candle breaks above the range, creating a turtle soup. The third candle forms a strong up-close thick candle, called an order block, which touches a key price level. Third candle opens above the high of third candle. Find your entry models in this order block, aiming to sell towards the opposing end of the range. If you're familiar with ICT concepts, this is known as a unicorn entry. For those who are looking for OTE, you can see we hit the order block, closing below the order block, retrace, and tapping in OB. This is OB entry. And once looking for OTE, enter here. Your goal is to target the opposite end of the range. When you move to the 1 hour time frame, you can refine your entry by looking for a lower time frame CRT. The CRT low and high on the higher time frame come from the 4 hour chart, so you drop down to the 1 hour chart to find your lower time frame CRT. On the 15-minute chart, you can refine the entry even more. Candle open, souping the range low of lower time frame CRT. For a bullish setup, buy below the open of the candle. So what open is this? This is the candle right after the hitting the key level on higher time frame on 4 hours. As you can see, we hit the key level range, low open, souping the low of the range, and third candle open, that is the shaded area here. As the price dips below this range low, it aligns with the lower time frame CRT, and you can enter long, targeting the other end of the CRT range. Finally, on the 5-minute chart, you'll see the same idea. The candle opens, dips below the 1 hour range low, and you wait for the next candle to open. Buy below this open and aim for a long position, targeting the opposite end of the higher time frame range while taking partial profits at the midpoint. If you study this as intended, all you will ever need are 3 candles. This is the turning point in your trading career. There are specific candles you need to focus on. It's crucial to understand which candles to pick and which ones have the highest probability. It's not random. You don't just go on your chart and choose any random candle to trade CRT with. First, define the range you want to trade. Are you a swing trader, day trader, or scalper? What range do you want to trade in? A monthly chart, weekly range, daily range, 4 hour range, 1 hour range, etc. Time is fractal. Choose a range. Whatever range you pick, you must be looking for the power of 3. There is always an open, high, low, and close, or open, low, high, and close on every single candle. This means that the power of 3 will always be present. When traders are profitable without consciously using the power of 3, they are still unknowingly using it. If you plan to trade using the monthly range, focus on the 4 hour chart. For the weekly range, focus on the 1 hour chart. For the daily range, focus on the 15-minute chart. If you're using the 4 hour range, focus on the 5-minute chart. For the 1 hour range, focus on the 1-minute chart. And if you're using the 15-minute range, you can look at the 15-second chart. However, I do not recommend using the lower time frames for entries. This approach is solely for identifying the power of 3: accumulation, manipulation, and distribution. Every candle has a function. As mentioned before, the price will always open, form a turtle soup, and then decline when the market is bearish, and vice versa when it's bullish. Candle 1 will always represent accumulation, candle 2 will represent manipulation, and candle 3 will represent distribution. The manipulation stage often offers the most advanced entries. This is where turtle soup occurs. The third candle, or the distribution stage, will provide the most optimal trade entries, which are especially suitable for beginners. To enhance your accuracy, blend the candles of CRT with the times when the high or low of the day, week, month, or year are formed. This will give you a more precise read on the markets. It's crucial. Go back and test this. Pause the video and back test. Look for the specific times when highs and lows of days are formed. This is where you should be looking for your CRT opportunities. If you enter on the third candle, the trade is likely to be very fast, quick, and heavy. Why? Because it is the distribution leg of the model. Always remember to take partial profits at 50% of the range. As mentioned before, reversals often occur at this point. If you're confused about the direction, ask yourself, who is getting caught off guard? Retail traders often buy above highs and sell below lows. You don't want to be selling when we are below a CRT low. Instead, you should be buying. Similarly, when we are above a CRT high, you don't want to be buying. You should be selling. The program, when we are bullish, there will be a turtle soup followed by a rally and then a drop close to the turtle soup low. This forms the failure swing low. What you'll observe is the price creating a turtle soup at a key level, rallying for a bit, dropping back down near the recently formed low, and then rallying back up. When we are bearish, the same pattern occurs. Turtle, soup, drop, rally, and then a drop close to the turtle, soup high. This forms the failure swing high. Every turtle soup will have this specific failure swing high, which tends to scare more people out of the market. Keep in mind that for this pattern to be correct, the turtle soup low must be created at a very specific time on your chart. This is not random. Let's look at these examples. Right here, we have a turtle soup where a key level is hit. Then there's a rally followed by a drop close to the swing low that was created with the turtle soup. This scares more people out, leading to higher distribution. The same thing happens here. There's a turtle soup at this year's low, which is also a key level. We hit a key level, forming a failure swing low, and then distribute to the opposite end of the CRT range and then higher. Notice how in both examples we hit a key level. That's why a failure swing occurred right afterward. Let's talk about how to enter using the candle range theory. The first way to enter, and the most advanced, is on the second candle with a turtle soup setup. The second way is using the order block or a change in the delivery state. The third way is through a market structure shift, followed by a breaker or an optimal trade entry. For now, let's focus on the order block, which is entry number 2. The key is to trade the order block only when the candle that sweeps liquidity is thick and strong. And this is important because such candles often trick people into entering the wrong direction. So if we sweep a CRT low and form a thick, heavy down close candle, that's a high probability order block to go long. The same applies in reverse when bearish. This is how we validate our order blocks. Never enter on a small or weak candle. The third candle in a CRT setup provides an entry based on Model 1, which combines the order block and turtle soup. This trade is typically very quick. You can also find an optimal trade entry, OTE, within this candle. In a 3-candle CRT setup, the final key is understanding the times when highs and lows are likely to form. Throughout the day, there are specific times when highs and lows have a higher probability of forming. Every high and low of each candle is timed. Nothing is random. The market consolidates at certain times and expands at others. Focus on studying the charts and concentrate on 1 or 2 asset classes at most. Learn them well and memorize their patterns. Here's a tip. Candle number 1 is accumulation. Candle number 2 is manipulation. And candle number 3 is the fast move. You want to get as many candle number 3s as possible. Ignore candle 2 and focus on getting those candle 3s. Don't force a turtle soup setup. If you're forcing it, it means you shouldn't enter the trade. The turtle soup entries you should take will be clear and obvious. Don't force anything else. Let's go through some more examples. We have a range with a high and low. When we do a turtle soup on the low, there's a wick below, but no close below it, so we are bullish. Where do we go next? To the opposite end of the range, the CRT high. Remember, this applies to every single time frame, but the highest probability CRT ranges will form at specific times of the day. Now let's examine the lower time frame. Candle 1 represents Monday, candle 2 is Tuesday, and candle 3 is Wednesday. The shaded areas show the higher time frame, but we're focusing on the lower time frame. Candle 1, which is Monday, forms the range. Candle 2, which is Tuesday, represents manipulation. And candle 3, which is Wednesday, represents distribution. Here's the sequence. Range high, range low, turtle soup on the range low, change in state of delivery, order block formed, order block hit and long, targeting the opposite end of the range. If you want to enter on the third candle, wait for it to open. You'll notice that the CRT low was souped with the second candle, which is Tuesday. When the third candle opens on Wednesday, wait for the price to move back below Wednesday's open and then long, targeting the CRT high. As you can see, this turtle soup is a model in itself. This is the Monday range model. I won't go into more detail, but for those who understand, this is a very high probability model. Using Monday as your range, Tuesday as manipulation, and Wednesday as distribution, you'll be able to catch a lot of trades and potentially make significant profits. Now, let's look more closely at candle number 3. As I mentioned earlier, there was a turtle soup. The quickest trades occur within candle 3. The bias is bullish because we souped the range low and closed above it with a wick below the range low. This indicates a bullish trend. Our goal is to wait for the price to reach below the third candle's open, creating a turtle soup where we souped at the midpoint of Tuesday's range. This is crucial. Very few people will tell you this, but it's key. Look for your turtle soups and your entries on the third candle at the midpoint of the second candle in a CRT range. To summarize, the first candle formed the range, the second candle manipulated it. An order block formed. The state of delivery changed, structure was broken, an order block formed, and then we tapped into the order block for a long entry. The third candle opened and moved back below its own open towards the midpoint of Tuesday's range, creating a turtle soup at that midpoint. Remember, I mentioned that turtle soups and reversals often happen at the midpoints of ranges, reversing back down to the CRT low. This is an A+ model and an A+ setup. You need to study this carefully. Rewatch this as many times as necessary. I'll repeat. Always look for the turtle soup at the equilibrium of the second candle in the range, below the third candle's open. Your first entry could be the turtle soup, and the second entry would be the order block that closes above and taps back into it for a long trade, targeting the opposite end of the range low. Here's another example. 3 candles form a range with a high and low. The wick above signals a bearish trend, and the third candle distributes on the lower time frame. The first candle formed the range high and low. The second candle souped the range high. An order block formed, closed below. Changed the state of delivery, CSD, tapped the order block, and shorted, targeting the opposite end of the range. When trying to spot the highest probable CRT, there are specific confirmations to look for. A CRT must form at a specific time. The liquidity sweep, also known as turtle soup, should also happen at a specific time. If there's a key level on a higher time frame within, below, or above the CRT, it increases the chance of a high probability CRT. Inside bars automatically indicate a high probability setup, as mentioned earlier in this video. A lower time frame CRT within a higher time frame CRT is another strong confirmation. These confirmations help determine whether your CRT range is high probability. Not all of these need to appear in one trade setup. Using 3 or 4 will still give you high probability models. Let's take a look at the higher time frame key levels. Using a higher time frame key level to validate the CRT high and low will increase your win rate. When identifying your CRT range, spot the higher time frame key levels, either below or above the CRT high and CRT low. Let me help you with finding these key levels. Key levels always come from a higher time frame, but not just any random higher time frame. This is where some traders get confused. For example, if you're on a 1-hour chart, you won't look for a level from the monthly chart. Here's the key. Remember the divide by 4 rule. What does this mean? If you have a higher time frame key level from the 1-hour chart, your CRT will form on the 15-minute chart. To reverse it, if your CRT is forming on the 15-minute chart, your key level will come from the 1-hour chart. 15 minutes multiplied by 4 is equal to 1 hour, or 1 hour divided by 4 is equal to 15 minutes. You can also apply this to other time frames. If you're looking at a CRT on the 1-hour chart, the key level will come from the 4-hour or daily chart. If you're on a 4-hour chart and looking at a CRT range, the key level will come from the daily or weekly chart. If you're on the daily chart looking at a CRT range, the key level would come from the weekly or monthly chart. And if you're on the weekly chart looking at a CRT range, the key level will come from the monthly or yearly chart. We want to see strong price movement when key levels are hit. We don't want to see price hanging around at key levels. Remember, if you ever forget, Just think divide by 4. If you're on a monthly chart, dividing by 4 gives you a weekly chart because there are 4 weeks in a month. If you're on a weekly chart, dividing by 4 gives you a daily chart. On the daily chart, dividing by 4 gives you a 4-hour chart, and so on down to 15 minutes. Here's a perfect example. This example involves a higher time frame key level within the lower time frame CRT, not below or above, but within. Understand that this is a 15-minute chart with the key level coming from an hourly chart. The CRT high and low formed, the key level was hit, and the range was created. We swept the range low and came back above the key level, causing price to explode upward. As soon as the price closed above the key level, it expanded quickly, targeting the CRT high. And this key level within the lower time frame CRT makes this CRT very high probability. Long positions here would have been excellent. As mentioned before, the key level came from the 1-hour chart. We swept the low and moved higher. This is the 15-minute chart zoomed in. You can see the CRT high and low with the key level within the lower time frame CRT. The sweep below led to a bullish entry, going long toward the other end of the range. Remember the divide by 4 rule. If the higher time frame key level is from the 1-hour chart, the CRT will be on the 15-minute chart. Now let's look at the entry. We're on the 1-minute chart because the CRT formed on the 15-minute chart. If you see a CRT forming on the 15-minute chart, you should use the 1-minute chart for your entries. This is crucial as it helps you align your charts and enter trades correctly. Here, you can see a sweep of the CRT low. As soon as the price closed above, it indicated a change in the market. This validated the order block. Why is this an order block? It's a strong down close candle touching the key level and tapping the CRT low. Once it closed above, the entry on the tap was a long trade toward the other end of the CRT range, offering a very high risk to reward trade. Let's now look at an example of a CRT with a higher time frame key level either below or above the CRT. As you can see here, the CRT is forming on the 1-hour chart, and the key level is coming from the 4-hour chart. The key level is above the CRT high. As soon as we sweep the CRT high, we're likely to hit that key level, which represents a high probability trade. Then we target the opposite end of the 1-hour range. As mentioned earlier, if the CRT is on the 1-hour chart, the key level will come from the 4-hour chart. Having a key level below, above, or within your CRT from a higher time frame is crucial for achieving a high success rate with CRT. This is what creates high probability CRT setups. They are not random. If your CRTs aren't working when you try to execute trades, it's likely because you're not using key levels. Now, let's move down to the 5-minute chart for entries. Why? Because the CRT is on the 1-hour chart, so we'll use the 5-minute chart for our entries. Write this down. An order block formed. How is this an order block? It's a strong up-close candle that taps both the CRT high and the key level. Then there's a turtle soup with price closing below the order block indicating a change in market behavior. The price then taps back into the order block, providing an entry for a short trade, targeting 50% of the range, as well as the opposing end. Using key levels will help you identify where turtle soups and the specific highs of turtle soups will form. Let's discuss another confirmation technique using a lower time frame CRT within a higher time frame CRT. This approach represents a high probability trading scenario. Start by going to a higher time frame like the 4-hour chart and mark your CRT. Identify the high and the low. Wait for one end of the range to be hit. Then switch to a lower time frame like the 1-hour chart and divide by 4. Draw the CRT on the candle that hits the higher time frame's CRT high or CRT low. I'll show you an example of this, so don't worry. This specific setup is key to forming significant highs and lows. It's an essential pattern in price action that will reveal a lot to you. Here's an example of a lower time frame CRT within a higher time frame CRT using a key level from the 4-hour chart. This is our higher time frame CRT high and low. The CRT high was hit, so we moved to the lower time frame. As you can see, the 1-hour CRT's low and high were also respected. The 1-hour CRT was formed within the 4-hour CRT. This is crucial. As shown here, the 1-hour CRT high and low were established within the 4-hour CRT high and low. Understanding this concept is very important, as it will help you identify key highs and lows. For instance, the price continued to drop significantly here, over 150 points in the Nasdaq. Get familiar with this setup: a lower time frame CRT within a higher time frame CRT. This is critical and very important. Many of you have probably been waiting for this section on CRT and entries. If your CRT is on the monthly chart, your entries should be taken from the daily chart. If your CRT is on the daily chart, your entries should be on the 1-hour chart. If your CRT is on the 4-hour chart, the entries should be on the 15-minute chart. If the CRT is on the 1-hour chart, then your entries should be on the 5-minute or 1-minute chart. If you're using the 15-minute chart for CRT, then your entries should be on the 1-minute chart. It's important to understand that you shouldn't be drawing CRTs on the 4-hour chart and executing on the 1-minute chart. This is how losses happen. Proper alignment will lead to quicker success. Now let's look at high probability CRTs. For Forex, focus on 1 a.m., 5 a.m., 9 a.m., 1 p.m., 5 p.m., and 9 p.m. For futures, key times are 2 a.m., 6 a.m., 10 a.m., 2 p.m., 6 p.m., and 10 p.m. These are specific times on the 4-hour chart to look for CRT ranges. In Forex, the first week, especially Monday and Friday, along with the key times of 1 a.m., 5 a.m., 9 a.m., 1 p.m., 5 p.m., and 9 p.m. is crucial. For example, Monday might display a high probability CRT with turtle soup on Tuesday and distribution on Wednesday. Friday also has high probability CRT ranges. For futures, focus on the first week of the month, particularly Monday or Wednesday at 2 a.m., 6 a.m., 10 a.m., 2 p.m., 6 p.m., and 10 p.m. Now that we understand the high probability CRTs and when they form, the next step is to learn about high probability turtle soups and purges. Turtle soups need to form at specific times to be considered high probability. If the turtle soup doesn't occur at the right time, don't take the trade. For example, if you expect a turtle soup at 3 a.m., but it happens at 2 a.m., don't enter. Wait for the next setup. Keep it simple. Filter your trades by looking for turtle soups at 3 a.m., 6 a.m., and 9 a.m. Remember when I mentioned 3, 6, and 9 a.m.? Another time to watch for is 1 a.m. There are many more high probability CRTs and turtle soups. Go back and test them yourself. But for now, focus on 3 a.m., 6 a.m., 9 a.m., and 1 a.m. This means your CRT ranges can form at 2 a.m. and a turtle soup can form at 3 a.m. So let's align your CRTs with turtle soups. The CRT range will form in the first week of the month, and the turtle soup will occur in the second week. The CRT range will form on Monday, and the turtle soup will form on Tuesday or Wednesday. Why Tuesday or Wednesday? Because Tuesday can be an inside bar, and Wednesday can be the turtle soup. For a high probability CRT, if the CRT forms on Friday, the turtle soup will occur on Monday. If the CRT forms at 5 p.m. on the 4-hour chart, the turtle soup will form at 3 a.m. If the CRT forms at 9 p.m. on the 4-hour chart, the turtle soup will occur at 1 a.m. or 3 a.m. If the CRT is forming at 5 a.m. on the 4-hour chart, the turtle soup will occur at 9 a.m. This entire slide contains enough information to make you a successful trader. Not many people are going to reveal this kind of information on YouTube, Twitter, or anywhere else. This is what controls the markets. Study it carefully. Now let's look at an example for Forex. If the CRT formed at 5 p.m., where will the turtle soup occur? If the CRT formed at 5 p.m., the turtle soup will form at 3 a.m. As you can see, the 3 a.m. turtle soup is on the 4-hour time frame, distributing to the opposite end of the range. If we go back, you can see the 5 p.m. 4-hour CRT and the 3 a.m. turtle soup. Exactly what happened here. Let's take a look at a futures example on a 4-hour chart. At 10 p.m., we formed the CRT range, and at 1 a.m., we had the turtle soup, which then distributed to the opposite end of the range. As I mentioned before, in futures, You want to pay attention to 2 o'clock, 6 o'clock, and 10 o'clock on the 4-hour time frame. A 10 p.m. CRT and 3-6, 9 o'clock, plus 1 o'clock for turtle soups, CRT at 10 o'clock, turtle soup at 1 o'clock. It seems like magic, right? Another example here on Forex, a 5 a.m. CRT range high and low, a 9 a.m. turtle soup, and the other candles distributing to the range high. This is CRT perfection right here. As mentioned before, if the CRT forms at 5 a.m., the turtle soup will form at 9 a.m. Study that, rewind, and listen again to exactly what I just said. We're near the end of the video, and I think it's important to add a bit of psychology here. Strategies, models, code signatures, these are all essential parts of trading. But psychology, my friends, is what will set you apart from beginners. Let's explore something I call the filter process. You need to apply filters to your trades. Filter out the low probability trades because they waste your time, energy, and money. Save your capital for high probability trades only. This is what separates beginners from professional traders. It may sound like common sense, but beginners often fall into the trap. Let's look at an example to make it clearer. If you've properly backtested and studied, you'll notice a specific pattern in price that stands out to you. It's always clear, and you naturally prefer it. Let's call this your A+ setup. The retail trading community often calls it that. But here's a secret. Many retail traders don't realize that this A+ setup should be the only setup they execute. It's not just an A+ setup, it's simply the setup. Many retail traders would do much better if they understood this. To simplify, while backtesting, you'll see higher probability setups, like A+ setups, and lower probability ones as well. You might be tempted to execute on A+, B+, and C+ setups, but instead, you should treat that A+ setup as the only setup you should execute on, the one you can spot clearly. The highest probability setups are the only ones worth executing. Filter out everything else. If it's not an A+ setup in your eyes, don't take it. For instance, if you prefer inside bar CRTs, wait for those. Don't force other types of CRTs. There will always be more opportunities. For example, if you like inside bar CRTs, don't trade the 3-candle CRT. It's that simple. Many traders fall victim to impulses or gut feelings. They'll find any reason to justify an entry, even when there's nothing on the chart. Sound familiar? This is another key difference between professionals and beginners. Set yourself apart. Focus on your risk-to-reward ratio and your percent gain-loss. This is extremely important. I haven't talked much about this yet, but if I get enough comments, I will. It might be boring, but it's crucial. Without a proper risk-to-reward ratio, you won't succeed with CRT. Set a standard risk-to-reward for yourself, whether it's 2-1, 3-1, 1-1, or 5-1 RR. Whatever it is, stick to it. If you only want to take 3-1 trades, then only take those trades. Don't settle for a 2-1 trade. If a 2-1 trade shows up, don't take it. Wait for a 3-1 trade to form. If it doesn't happen today, wait for tomorrow. If it doesn't happen tomorrow, wait for the next day. Be patient. That wraps up everything you need to know about CRT. This is a lot of information, and I don't expect you to take it all in at once. Take your time and let your brain absorb the knowledge. If you don't, you won't retain anything. Study price, get to the charts, backtest, and learn. I appreciate all the love and support. Good luck, traders, and I'll see you next week.